Okay, everybody, we are starting chapter 3 this week. I just want to make sure that it does show I am sharing the correct screen. Okay. We have come a long way in 2 weeks. We're understanding what the accounting is. It's basically communicating information to end users. And we've also spent time understanding how we analyze various transactions and decide, how do we measure these? What's going up? What's going down? What accounts are being affected? And we're learning how to record that in the form of a journal entry. And then we also talked about posting them to the general ledger. We had some problems doing that, some homework problems. And then we ended last week by creating a trial balance where our debits need to equal our credits. And what is a debit? Left. And what is a credit? I'm not going to let you forget that. This week, we're going to talk about the adjusting process. There are items in our books that will need to be adjusted. So we're going to have to come up with some journal entries to adjust the numbers to make them accurate with what's actually going on. Before financial statements can be prepared, some accounts on that unadjusted trial balance need to be corrected. These adjustments are necessary because the transactions were recorded using the accrual basis of accounting. So with the accrual basis of accounting, we record revenues when we earn them. We record expenses to match those revenues they help to make. Okay? Under the accrual basis of accounting, revenues are reported on the income statement in the period in which a service has been performed or a product has been delivered. Cash may or may not have been received from customers during that period. We don't record revenue when we get the money from the customer. We record the revenue when we earned it, when we delivered the product or service, right? The accrual basis of accounting requires expenses to be recorded when they're incurred, not necessarily when cash is paid. So when we're dealing with the accrual basis of accounting, which is required by GAAP, generally accepted accounting principles, we record revenues when we earn them. Under the cash basis of accounting, which is way easier, revenues and expenses are recorded only when cash is paid. So it can be distorted because cash might not be paid until the next year. And that's when we would record the revenues, even though we earned them in the previous year. Now, small businesses often will use the cash basis of accounting. But in this class, we're kind of talking about large companies that are required to follow generally accepted accounting principles. So small little businesses like my own, I just use the cash basis of accounting because it's just not that big. I don't have loans. I don't have a need to report my financial statements to someone to get money. You get what I'm saying? But for most practical purposes in this class, the accrual basis of accounting is required for most businesses. The revenue and expense recognition to be useful for decision-making, financial statements are provided on a periodic basis. What does that mean? Well, our income statements are generally done in every 12 months. from January to December. Some companies use a different fiscal period, but it's still, generally speaking, 12 months. There are some times, although I've never done a return for that, when businesses have a longer operating cycle than a year. And it's usually when their products or whatever they're building take a lot longer to complete. But know that for the most part, most of us operate on a fiscal 12-month cycle, and that 12 months can be split into months, quarters, and years. Under this revenue recognition principle, revenues get recorded when they're earned, which is when the services have been performed or the products have been delivered to the customer. Revenue is normally measured as the assets are received, such as cash or accounts receivable. So if you don't get cash when revenues have been performed, you're going to generally use accounts receivable, which means that individual you're going to receive money from that individual. They just haven't paid you the cash yet. Make sense? Everyone following me so far? The expense recognition principle, which we can also call the matching principle, means the expenses are incurred under the expense recognition principle. The expenses incurred in generating the revenues need to be reported in the same period as those revenues, because you want to match them. You want to match the revenues and the expenses. What did it cost to make those revenues? You want to match them equally. By matching revenues and expenses, net income or loss for the period is reported on the income statement. We're going to get into these adjusting entries. These adjusting entries we're going to look at today are required to properly match revenues and expenses. So we ended last week with creating journal entries, posting them to the accounts, and then preparing what we called an unadjusted trial balance, which means we listed all of the accounts. And if they were a normal debit balance, we showed the debit balance. If it was a normal credit balance, we showed the credit balance. And at the bottom, our debits equaled our credits. But we're going to talk that some of these accounts need to be adjusted. Some expenses aren't always recorded daily. The biggest one we're aware of is supplies. At the end of the period, we may have started at the beginning of the period $1,000 of supplies in our cabinet. But at the end of the period, we look in and we go, oh, there's only 100 left. That is an adjusting entry. It's something we need to report to make our revenues and our expenses balance. Okay, that's one example that we've kind of already done, guys. Some revenues and expenses are incurred as time passes rather than as a separate transaction. For example, if we received rent in advance, say, let's say we have some homes or office buildings we rent, and we had a customer give us 12 months worth of rent in advance. We know that rent isn't revenue when we first received it, is it? Because rent revenue happens just with the passage of time. So if they gave us 12 months of revenue in advance for the whole year, and this is January, we're going to show all those 12 months as a deferred revenue because we didn't earn it yet, right? It was a liability until the passage of time that customer is renting that space. So at the end of January, or at the beginning of January, we will take that deferred revenue and show rent revenue for the month of January. Or we might show after February rent revenue for the month of February. But what if we're at December 31st And we have deferred revenue of rent sitting on our books for 12 months. But guess what? It's all used up now. Wouldn't that be an adjusting journal entry we need to do to show, oh, that's not a liability anymore. They gave us that money back in January, and guess what? The 12 months have passed. Does that make sense? That would be an adjusting entry we need to do to show that money has actually been treated as revenue. It's no longer a liability. Or what if a company may have provided services to customers that it has not billed or recorded at the end of the accounting period? So what if we did in fact, I'm an attorney and I have worked on a document for you and I've given it to you, but I have yet sent you a bill. I do need to be aware of, hey, what revenues are out there that I haven't sent the bill yet for, so I can show that revenue is linked with this period. Does that make sense? Those are the adjusting entries we're talking about. The analysis and updating of the accounts at the end of the period before we prepare financial statements, we call that the adjusting process. And the journal entries we're going to use are called adjusting entries. So unlike just normal transactions where we pay salaries, where we pay rent, where we receive revenues, those are just journal entries throughout the period. At the end of the period, what I'm talking about now, we're going to call adjusting entries. All adjusting entries will affect at least one income statement account and one balance sheet account. So an adjusting entry will always involve a revenue or an expense or an asset or liability. Know that, okay? Got it, guys? An accrual occurs when revenues have been earned or an expense has been incurred, but we haven't recorded it yet. If the accrual is for revenue, the adjusting entry debits an asset, accounts receivable, and credits a revenue account. That makes sense, doesn't it? So an accrual means we need to report this revenue. So we're going to debit our receivable because we haven't gotten the cash, and we credit our revenue. If it's an expense, we're going to always debit the expense and credit either an accounts payable or a wages payable or something payable. And we know whenever we have the word payable after it, what is it? A liability. Remember, the only liability that doesn't have the word payable after it is deferred revenue, right? So, know that for an accrued revenue, during the year, we've not put anything in, which is why at the end of the period, we need to show that revenue was earned by debiting accounts receivable and crediting our revenue. No, for accrued expenses, we will debit an expense and will credit a payable. So that we've got accruals and now we have deferrals. A deferral occurs when cash related to a future revenue or expense was initially recorded as a liability or an asset. If the cash received is related to a future revenue, it was initially recorded as a liability. I call it deferred revenue or unearned revenue. In other words, we received the cash, but we didn't do the work yet. So when we create an adjusting entry for deferrals, what we need to do is we need to adjust that liability and show that in fact we did earn the revenue has in fact been earned. So the adjusting entry in the period when the revenue is earned debits the unearned revenue account or that liability. So if you debit it, you decrease it, and it ends up crediting the revenue account. The other deferral related to expenses is we paid a year's worth of insurance up front. So we would debit prepaid insurance and credit cash, right? At the end of the year, if we see that 6 months of that insurance has been used up, we would show that as an insurance expense and reduce our asset prepaid insurance. Does that make sense? Because when we pay money up front for an expense, but we haven't used it up yet, we show that as an asset. Primarily, that's supplies. Oftentimes, it's prepaid rent, prepaid insurance. So we pay it up front, but we haven't used it yet. As we use it up, we reduce that asset and we increase the expense. Okay? So no, with deferrals, we've paid the cash up front, but we're now recording the use of it or the revenue earned. For revenues, we're going to debit our unearned revenue, which means reduce that liability and credit our revenue. Or for a prepaid expense, we're going to debit our expense and credit our asset, the prepaid expense. Those are the adjusting entries we're talking about. So here we see an unadjusted trial balance. This was after we recorded all the transactions, we posted them. Here is our unadjusted trial balance. In order to arrive at our adjusted trial balance, we need to report these adjusting entries. So here is our chart of accounts, and we've added a couple new ones. We've added rent revenue, insurance expense, depreciation expense, something called wages payable, but we know it's a liability, it's a payable. And then something new called accumulated depreciation on office equipment. So let me just say in a nutshell that when we buy an asset, such as a building, or such as this projector, or this furniture, an asset is a resource that's going to benefit us for many periods, many future years. But this computer, this screen gets worn out over time. Does that make sense? Nothing stays perfect. And so we find a way to write off how we're using up that asset. So for example, this building, I mean, we know it lasts more than 40 years, but we depreciate buildings generally over 39 or 41 years, which means what we paid for it is going to get worn out. The pipes are going to need to be replaced. It needs to get updated. The carpeting needs to be fixed. Do you guys get what I'm trying to say? So even though we might have bought this building for $1 million, we get to write off a piece of that building over, say, 40 years. It's not like supplies expense that get used up in that year. It's going to get worn out. So we get to write off a piece of it, which we call depreciation. This projector, I don't even know what it would cost. $3,000, you think? This projector probably can last 7 years, or probably, hopefully longer. But through just time and wear and tear and the projector going up and down, you know what I'm saying? It's going to get worn out and ultimately need to be replaced. So this projector that could have cost $4,000 or $5,000, we write that $4,000 or $5,000 off over 7 years, say, because we think its useful life is going to be 7 years. That writing off a piece of equipment is called depreciation. And in depreciation, we have this other account we use to keep track of all the depreciation we've taken on a specific asset called accumulated depreciation. It's called a contra account. I don't want to confuse you too much, but I just wanted to take some time and explain what depreciation is, okay? During an accounting period, some revenues are recorded only when cash is received. At the end of the accounting period, there may be revenues that have been earned, but we haven't recorded yet. In such cases, the revenue is recorded by debiting the asset called accounts receivable and crediting the revenue account. So let's say Net Solutions signed an agreement with Danker on December 15th to provide services at a rate of $20 an hour. As of December 31st, Net Solutions had already provided 25 hours of service. It could be that Net Solutions was going to bill them once a month. They started December 15th. They were going to bill them on January 15th. Okay. But December 31st is the end of the period. And so we need to show, hey, how much have we earned in this period? We need to report. So as of December 31st, we see Net Solutions had provided 25 hours of services. We need to show that adjusting entry that shows we debit our accounts receivable for 25 hours at $20 an hour or $500, and we credit our fees earned. Does that make sense? Even though we're not going to invoice them till January, the period is ended and we need to show what revenues we earned in this period. If the adjustment for the accrued revenue, $500, is not recorded, then our financial statements will be off. Our revenues are going to be down $500, and our asset accounts receivable is going to be decreased by $500. Make sense? So by omitting that journal entry, we're going to reduce our revenues. We'll have reduced our revenues by 500, and ultimately our which affects our owner's equity, and our assets, that accounts receivable, would have been understated by $500. Some types of services used in earning revenues are paid for after the services have been performed. At the end of the accounting period, the amount of such accrued but unpaid expenses is an expense and a liability. An adjusting entry is necessary so that expenses are properly matched to the period in which they were incurred in earning revenues. Perfect example, employees. Net Solutions pays its employees every other week. Remember, bi-weekly means every other. Semi is twice a month. Do you guys know what I'm talking about? Bi-weekly means every other week. Semi means 2 times a month. It can get confusing. Maybe that wasn't confusing to you guys, but so during December, Net Solutions paid wages of $950 on December 13th and $1,200 on December 27th. Those payments covered pay periods. That makes sense, every other week. But guys, what happens? It's now December 31st. We last paid our employees on the 27th. But to keep this year's financial statements accurate, don't we need to accrue the last 3 days of the period and show, hey, there were salaries expense that were incurred in these last 3 days, even though we haven't paid them? That makes sense? If we don't do that, our expenses get understated and our liabilities get understated, right? So, as of December 31st, Net Solution owes $250 of wages to employees for Monday and Tuesday. So the wage expense account gets debited by $250, and the wages payable, a liability, also gets credited or gets increased by $250. Does that make sense? So you see, the pay periods happened every Friday. But since the end of the year is on the 31st, we need to take these 2 days that they'll get paid in January, but they incurred that expense now. We incurred that expense now. We need to show that. Make sense? The journal entry to show that is a debit to wages expense for $250 and a credit to wages payable for $250. Okay? As shown in Exhibit 5, Net Solutions paid wages of $1,275 on January 10th. The payment includes the $250 of accrued wages that we recorded on December 31st. So this journal entry, when we actually pay the wages on December 10th, is going to show a wage expense for those days in the next year, in January. It's going to show the wages payable of $250 that was accrued in December, and the difference is going to be the cash. Because we want to show those wages expense in December for those salaries that were earned in December or incurred. Okay? Make sense? If the adjustment for wages, $250, isn't recorded, then wage expense is going to be understated by $250 and net income will be overstated by $250 on the income statement. So when we're dealing with accrued expenses, if we don't record the expense, our net income gets overstated and our liabilities get understated. Okay? When we record the expense, then our net income is going to go down and ultimately our owner's equity goes down. So the whole purpose of these accrual entries is to accurately show what's really happening in the business. Guys, at the end of an accounting period, an adjusting entry to record revenue that has been earned but not yet recorded would include which of the following? I want you guys to think about this. Think about it. So we didn't record revenue. We have revenue, but we didn't record it yet. So when we need to show an adjusting entry to show, hey, revenue was earned and we're going to receive some money soon, how do we handle that? Anyone? Credit revenue. Perfect. Did you guys hear that? When revenue was earned, but we haven't recorded it yet, our revenue goes up, which is a credit, and our accounts receivable, which is an asset, goes up, which is a debit. Does that make sense? Isn't it so easy when you do it together? And then do you ever sit at home and you're like, how, God, this is hard. Boy, when I'm in class, it makes sense. That's why it's nice to do those problems. Okay, let's look at this problem. At the end of the current year, $17,950 of fees have been earned, but have not been billed to clients. I'm going to run to the restroom because I'm on my third water today. I want you guys to think of how do we need to record this? Okay. At the end of the year, we had $17,950 of fees we earned, but we haven't billed it out. What is it we need to do as an adjusting entry to show we earn that money and we're supposed to receive something? 2 minutes. I'll be right back, and hopefully my dog won't follow me. This is cracking me up. It's like he wants to see everything.
What's his name?
Denali.
No.
He was, when I got him 3 years ago, he wouldn't bark. Did I tell you about this for the first 2 years? But I knew he barked because he'd bark in his sleep. But like, he would normally be hiding behind here. Yeah, you like all these people. I'll be right back. Did I tell you about the drone I had to hire? He got lost on our farm in May, and for 3 days, I couldn't find him. So we had to hire a drone to go find him.
Oh, gosh.
But they found him.
Was that like a thermal drone?
Yes.
Okay.
And the minute it went up, because animals have different body heats. I didn't know that either.
Oh,
And so he saw a dog that was black, and the thermal was the temperature of the dog. He even found a bear hiding in a tree.
That's actually kind of cool though.
Well, it's kind of scary because I was down there.
Oh.
You know? Okay, I'll be right back. I'll be right back. Okay, hey, work.
Oh, yeah, right. All right. What's the question? You're supposed to like write this down or something. What? Oh, so it's like accounts receivable. Accounts receivable. Oh, we're just like supposed to categorize it. Yeah, that's accounts receivable. Yeah. But, yeah. Then B, I use. They gave me the term on this part. If you guys remember what the cash basis and accrual basis is, I'll see that I was not as attention to that. So cash basis is, it reports on transactions when the cash is received or paid. Accrual basis reports only the accrual. There's no way, when it's. Right, see. Does that make sense to you? You explain it. I'm not positive in mind what that's trying to say. Yeah, I was like, so I paid, really? Yes, 17,000. If they pay it, instead of on being. Okay. Which would be that. Okay.
So what do you guys think? What are we gonna do? How would we journalize this? We debit accounts receivable, and read credit fees earned. I don't think I have that in here. I'm sorry. So here, let me just. That is so weird. So I'm going to duplicate this. We're going to credit accounts receivable of 17,950 and credit fees earned. That makes sense, guys? Now, the next question says, if the cash basis rather than the accrual basis had been used, would we even need an adjusting journal entry? The only reason we're doing adjusting journal entries is for the accrual method, okay? If you're using the cash method, you don't need any adjusting entries because there's nothing to adjust. Got it? How about this one, guys? Stenberg Realty pays weekly salaries of $18,500 on Friday for a 5-day work week, ending on Friday. Journalize the necessary adjusting entry at the end of the accounting period, assuming that the period ends on Monday or on Tuesday. So what's the first thing we do? If 18,500 are salaries for a week, wouldn't we figure out what salaries are for a day? What are salaries for a day? I have the calculator. Wouldn't they be 3,700 a day? So if the period ends on Monday, it would be salaries expense 3,700, salaries payable 3,700, right? And if it was on Tuesday, wouldn't it be double that or 7,400? Yeah. Salaries expense 7,400, salaries payable 7,400. Does that make sense? Okay. Wait, what was that? Oh, it said Thursday. I thought it said Tuesday. Thursday. So in that case, it would be times 4 days or 14,800. Got it? How's everyone doing? Making sense? Okay, what about this one? The wages payable and wages expense accounts on February 28th, after adjusting entries, have been posted at the end of the first month of operations. They're shown in these T accounts. How would we determine the wages that were paid during the month? I want you to think about this. You're welcome to talk to someone. Think this through. It's kind of easy. If we have wages expenses of $54,750, wouldn't that include the $7,300 we still owe? Right? It would still include that, because think about it. When we owe $7,300, we debit wages expense, we credit wages payable, right? So wouldn't it make sense what we've already paid is the $54,750 minus the $7,300? Does that make sense? See, guys, a lot of what we're doing here, sorry, or 48,073. A lot of what I'm trying to help you see are just how everything does make sense. It all balances right. It all makes sense. There's always a logical explanation. In this case, those wages payable of $7,300 is included in that expense. So we need to subtract that out to show what we've actually paid in cash. Yes? Yes? No? Do I need to say it a little different? How about this? Oh, we did that one. Okay. Moving on. The December 31st unadjusted trial balance of net solutions indicates a balance in the unearned revenue count is 360. That unearned revenue account means that's money we have not yet earned. The balance represents the receipt of 3 months of rent on December 1st for December, January, and February. So basically, we received $360 on December 1st. And that $360 is for 3 months of rent, 120 in December, 120 in January, 120 in February. Am I making sense? At the end of December, we've used up a month, or we've earned it, right? So we need to create a journal entry to show $120 of this unearned rent revenue is no longer a liability, it's now rent revenue, right? Do I need to say it a little different? Am I confusing you? So what journal entry adjusting journal entry do we need to report to show that the liability went down $120 and our rent revenue went up $120? Absolutely. Woohoo, woohoo. Yes. Does that make sense? Why though? We initially showed $360 of a liability because we hadn't earned it yet. But now we've earned 120 of it, so we don't owe that 120. That liability's gone down $120, which means we debit it and we credit our rent revenue because now we've earned it because a month has passed. Got it? Tell me, hey guys, tell me to do another one. So in this case, you see our debit, unearned revenue, and we credited our rent revenue. If the preceding adjustment of unearned revenue and rent revenue isn't recorded, then the financial statements would be off because we would be showing more liability than is true, and we would be showing less revenue than is true. Make sense? The December 31st, 2023 unadjusted trial balance of net solutions indicates a balance in the supplies account of $2,000. In addition, the prepaid insurance account has a balance of $2,400. Each of these accounts require an adjusting entry. Why? Because chances are we've used up supplies, and with prepaid insurance, just through the passage of time, insurance expires. You don't want to get in a car wreck and use your insurance. But sometimes at the end of the year, you go, God, I'm paying all this money for what? Well, you don't want to have to, you know what I'm saying. Get it? So in this case, we are showing we've used up $1,240 of the supply sitting in that cabinet. Got it? And the way we're showing it is we now show a supplies expense and we've reduced our asset. So our expense increased and we reduced our asset. So what happened here? Our net income went down and our assets went down, didn't they? For prepaid insurance, the debit balance of $2,400 in Net Solutions prepaid insurance account represents a December 1st prepayment of insurance for 12 months. So on December 1st, we paid for 12 months of insurance. How much on 2,400 would insurance be a month? 2,400 divided by 12 is $200. Got it? So at December 1st, we paid it all. Now it's December 31st. 1 month of insurance is used up. What are we going to do, guys? We need to reduce our asset and increase our expense, don't we? So wouldn't we debit insurance expense for $200 and credit our prepaid insurance for $200? Yeah? Guys, it's just like the supplies. It's just like the supplies cabinet that's missing stuff. Okay? We reduce our asset and increase our expense. If the preceding adjustment for supplies and insurance are not recorded, the financial statements are misstated because our income statement would be too high and our assets would also be too high, right? So our expenses would be understated and our assets are overstated. Make sense? Payments for prepaid expenses are sometimes made at the beginning of the period in which they will be entirely used or consumed. To illustrate, the following December 1st transaction of Net Solutions is being used. On December 1st, Net Solutions paid rent of $800 for the month. The rent payment of $800 represents prepaid rent. This is a little extreme, but we'll go with it. However, the prepaid rent expires daily, and at the end of December, there will be no asset left. In such cases, the payment of $800 is recorded as rent expense at the beginning of the month. That's more realistic, guys. Does that make sense? Because if you show December 1st prepaid rent, you're going to have to go and do another journal entry in 30 days. So oftentimes, if we're paying rent for the month of December, we just treat it as a rent expense for the whole month. It's just easier. Got it? How about this one, guys? On November 20th, Cassie purchases a $200 ticket on Delta Airlines to fly to Orlando on January 28th of the next year. Assuming Delta Airlines has a fiscal year of December 31st, which account would it credit to record the sale of this airline ticket on November 20th? Yes. Anybody? Anyone can say yes. Unearned revenue, absolutely. Why?
You got the money from nothing.
Absolutely. And guys, with airline seats, you never know what goes on, right? We, this is years ago, there were my family and then one of my daughters was bringing her boyfriend. So we had tickets to go on a cruise. And so we had airline tickets to get us to New Orleans for the week-long cruise. And we get to the airport and it's icy. And they wouldn't rebook us. And our cruise leaves in 24 hours. So needless to say, and we didn't have a car for 6 of us. We only had a truck with a topper on it. So one person had to be in the back on the topper. Don't tell the police that. And it was like 20 below, you know. Anyway, we made it. But that is a perfect example of why they can't show that as revenue until the flight actually takes place. Because in that case, they had to give us our money back. Okay. So unearned revenue, excellent. How about this one, guys? Classify the following items as accrued revenue, accrued expense, unearned revenue, or prepaid expense. Let's do the first one. A 2-year premium paid on an insurance policy. That is a prepaid expense. Get it? It's an asset. We're paying 2 years of an insurance policy. That gives us a resource of insurance for 2 years, doesn't it? What about fees earned but not yet received? Accrued revenue. Because these are fees, we earned them, but we haven't gotten the money yet. Okay, accrued revenue. Fees received but not yet earned, that's unearned revenue. Salaries owed but not yet paid, accrued expense. Subscriptions received in advance by a magazine publisher, unearned revenue. Think of this. Vikings. How many of you guys are Vikings fans? Or Twins fans? When you buy a season ticket, that season ticket is for how many games? Say 6 or 7 games. So when you give them your $10,000 up front, what do the Vikings show that $10,000 to be? Unearned revenue, isn't it? And only with the passage of each game do they record that as revenue. Make sense? Do you guys think these football games are rigged? You know how they say that the Super Bowl's rigged? How can it be? Yes, no. Who thinks they are? Did y'all not think this was about accounting? It isn't. Anyone have opinions? Yeah, yes.
I do think that like ref tend to change their bias. I don't think it's against the rules for an NFL ref to bet on a game.
But when I say they're rigged, I don't see how any player is not going to want to win the damn Super Bowl.
I mean, when you look at like players taking huge contracts that in the end for their team, I think it is a big more about the money. Like,
Yeah.
the Bengals suck right now because they can't afford anyone else besides Joe Burrow and Mark Chase. It's because they took such a bad contract. So like obviously winning's not that big of a deal for them.
Oh, it just makes me so sad.
And I don't blame my if you're risking getting lobotomized like brute force trauma, I'd take it back. So,
Ugh. Okay, that wasn't about accounting, but thank you. Supplies on hand, prepaid expense, it's an asset. Taxes owed but payable in the following year, accrued expense. Utilities owed but not yet paid, accrued expense. These are examples of adjusting entries. Okay? Are they prepaid expense? Are they unearned revenue, accrued revenue, or what am I missing? Accrued expense. Okay. I'm going to let you guys see this. The balance of the unearned fees account before adjustment at the end of the year is $18,000. Journalize the adjusting entry required if the amount of unearned fees at the end of the year is $3,600. So what that means is they were at $18,000. We must have earned those revenues because now it's down to $3,600. What would we do here, guys? Wouldn't we 14,400 debit our unearned fees and show fees earned? Right? The balance of supplies, the balance in the supplies account before adjustment at the end of the year is $5,175. Journalize the adjusting entry required if the amount of supplies on hand at the end of the year is $615. What are we going to do, guys? That difference goes to where? Supplies, expense, and we credit or reduce our supplies. How much? $4,560? Because we want 615 to be our balance, right? Right? The supplies and supplies expense accounts at December 31st, after adjusting entries, have been posted at the end of the first year of operations. They're shown in the following T accounts. Determine the amount of supplies that were purchased during the year. So in year one, at the end of year one, our supplies expense shows 7120 and our supplies shows 2550. How much did we purchase in supplies in this year? Wouldn't we add them together? Perfect, 9670. The balance in the prepaid insurance account before adjustment at the end of the year is 22,500. Journalize the adjusting entry required under each of the following alternatives for determining the amount of the adjustment. So if out of that 22,500, we say insurance of 18,000 expired during the year, what are we going to do to show that? What do we debit? Insurance expense of 18,000. And what do we credit? Prepaid insurance of 18,000. Excellent. What about this one? The amount of unexpired insurance applicable to future periods is 4,500. That's telling us that's what's left in the account, right? In the prepaid insurance account. So won't we take the difference and wipe it out? Wouldn't that be the same amount, 18,000? Whoops, excuse me. It'd be 18,000 also, right? Okay. The prepaid insurance account had a balance of $3,000 at the beginning of the year. The account was debited for $32,500 for premiums on policies purchased during the year. Journalize the adjusting entry required under each of the following alternatives for determining the amount of the adjustment. Okay, so guys, if at the beginning of the year there was 3,000 in there, and then throughout the year we purchased more insurance and we debited prepaid insurance by 32,500, what's our new balance in prepaid insurance? 35,500. So what we need to do is create a journal entry for the amount of unexpired insurance applicable to future periods is 4,800. If we want our prepaid insurance to have 4,800 at the end of the year, what do we need? What's the amount we're going to create as an adjusting entry? Anyone? $35,500 minus 4,800 is what? 30,700 would be our debit to insurance expense and our credit to prepaid insurance. Does that make sense? It's our beginning balance plus the 32,500 we added minus our 4,800 to show what was used up, what has expired. Okay. How about this one? The balance, is this making sense? The balance in the unearned fees account before adjustment at the end of the year is 97,770. Of these fees, 39,750 have been earned. In addition, 24,650 of these fees have been earned but have not yet been billed. Journalize the adjusting entry to adjust the unearned fees account and to record the accrued fees. So our 39,750 shows they're no longer unearned, they are now earned. So we're reducing our liability and we're increasing our revenue. And then of these, the 24,650 have been earned that have not yet been billed. So, excuse me, of these 39 have been earned. In addition, not of those, in addition, 24,650 of fees have been earned but have not been billed. So in this case, since we now have 24,650 of fees earned, but we've not billed them, we're going to debit our asset accounts receivable. Does that make sense? Now, depreciation. Remember, we were talking about those assets that get used up and we have to report a way to show that use. Fixed assets or plant assets are physical resources that are owned and used by a business and have a long life. Examples can include land, building, equipment. They're basically a long-term prepaid expense. It's a resource we have that's going to last us a lot longer than 1 year of insurance, isn't it? Or 1 year's worth of supplies. Fixed assets, such as office equipment, are used to generate revenues, much like supplies are used to generate revenues. But unlike supplies, we don't see a visible reduction in the quantity of the equipment. Instead, as time passes, the equipment loses its ability to provide useful services. This decrease in usefulness is what we're going to call depreciation. All fixed assets except land, you can depreciate. As a fixed asset depreciates, a portion of its cost gets recorded as an expense, and we call that expense depreciation expense. The adjusting entry to record depreciation is similar to the adjusting entry for supplies used. So we debit the account called depreciation expense. The difference is, instead of crediting building or crediting equipment, we credit something called building hyphen accumulated depreciation. Okay? We want to keep track of how much depreciation we've taken on each asset. But we don't directly just credit building. We show what we call a contra account that offsets the building minus the accumulated depreciation, shows us our net cost in the building. Okay? So accumulated depreciation accounts are called contra accounts, or we can call them contra assets accounts. This is because the accumulated depreciation accounts get deducted from their fixed asset on the balance sheet. So the normal balance is going to be, say this building was at $1 million and we've taken depreciation of 200,000. Our net building is really 800,000. Okay? The normal titles for fixed assets accounts and their related contra accounts are here. Buildings, the contra asset account for building, showing how much we've taken in depreciation, is accumulated depreciation on buildings. Or store equipment will be accumulated depreciation on store equipment or office equipment. Whatever that asset is, we're going to have a corresponding contra account keeping track of what we've taken already. Guys, land can never be depreciated. That's one asset we say never loses its value. Okay? The December 31st, 2023 unadjusted trial balance of Net Solutions indicates that Net Solutions owns 2 fixed assets, land and office equipment. Land doesn't depreciate. However, an adjusting entry is recorded for the depreciation of the office equipment. Let's just say in December, the office equipment depreciates by $50. If that's the case, we debit depreciation expense for $50 we credit accumulated depreciation on office equipment for $50. Do you see here that our asset of 1,800 is our equipment? Now that we've taken depreciation expense of $50 and we've credited the accumulated, do you see this net amount is really what our net office equipment is sitting at now? The 1,800 minus the 50? Okay? That's the net office equipment. After the adjusting journal entry is recorded and posted, the office equipment account still has a debit balance of 1,800. But the two balances combined give us what we call the book value of the asset. So we'll always keep those together. So this accumulated depreciation office equipment will be in the balance sheet, and it will be in the asset section right under our assets to show the net amount. Okay? No, the office equipment and its related accumulated depreciation would be shown as in the balance sheet, just like this, as a net amount of $1,750. So look here, in our income statement, that depreciation expense gets shown as an expense and it reduces our net income. In the balance sheet, we will put that accumulated depreciation right in line with the asset to show the net amount. Guys, what do you think of this one? Walsh Construction Company paid $120,000 for a used cement mixer truck. It has an estimated life of 10 years. After 6 years, the truck has accumulated depreciation of $72,000, and its net book value is which one? A. So 120,000 minus 72,000 gives us our 48,000. Excellent. The estimated amount of depreciation on equipment for the current year is $66,290. Journalize the adjusting entry to record depreciation. Guys, when we record depreciation, what are the two accounts we use? The first one is depreciation expense, and the next one is accumulated depreciation / equipment. I should have put in / equipment. Make sense? The balance in the equipment account is $3,150,000, and the balance in the accumulated depreciation for equipment account is $2,075,000. What is the book value of the equipment? Anyone with a calculator? Yes, someone's got one coming up. Does that make sense, guys? 1,075,000. And does the balance in the accumulated depreciation account mean that the equipment's loss of value is $275,000? No, it's depreciation in accounting purposes is an allocation of the cost of the equipment to the periods benefiting from its use. It's really not that we can say that's how it lost its value. We're just expensing a piece of that asset over its useful life. Does that make sense? So there are times, well, I will say this. I have a new computer. Well, it's only, actually, it's 2 years old. I don't know what my husband paid for it, maybe $2,000. But normally my computers last a year at best. And the reason that happens is I normally have, something you poke in the side, but it gets broken all the time. And then I screw up the inside of my computer. But this one, whatever it does, it pulls right out. Instead of it hooking into my computer, it's like a magnet and it just pulls out if I, mess it. As a result, I've had this for going on 3 years. So let's just say, for me, I would usually depreciate a computer over 1 year. For me, even though it's called equipment and we're supposed to be doing it over 7, it's just realistically not going to last me 7 years. So if I would have handled this the same and written it all off in 1 year, it sure doesn't mean the value is nothing, because look, I'm on year 3 with this. Am I making sense? So we're just depreciating to allocate a cost over its useful life. It doesn't mean that it's not going to be worth that amount. Perfect example, tractors. Say a tractor lasts you 5 years. Well, let me tell you, in this day and age, sometimes tractors are worth more than what you bought them for.
Yeah, that makes a lot more sense. I was a little bit confused about that at first. Like with some sneakers, for example, you can resell them and make like twice the amount.
Exactly.
Before.
There are things like that. But generally speaking, for accounting purposes, we get to allocate a piece of that cost over its useful life. Okay. And guys, think of buildings, our homes, even our office buildings. They always appreciate in value.
Yeah.
So even though you're taking a portion of that cost, you're gonna still have a gain. Okay, guys, adjusting entries are dated as the last day of the period because collecting the adjustment data requires time. The entries are usually recorded at a later date. And we always include an explanation with our adjusting entries. So, accrued revenues, no, services performed but not billed, or interest that needs to be received would be another example of accrued revenues. The reason services have been provided but haven't been billed, we would always debit an asset and we credit a revenue. Okay? So next, accrued expenses, wages or salaries incurred but not paid, interest that's incurred but we've not yet paid. In this case, expenses have been incurred but not yet recorded. We debit the expense and credit the liability. Or unearned revenues, unearned rent, magazine subscriptions, Vikings tickets. Money's been received in advance of services. So that's what we recorded it. But once they've been earned, we debit our liability and we credit our revenues, don't we? Then prepaid expenses such as supplies, prepaid insurance, prepaid rent. The prepaid expenses have been used or consumed in the business. What we do is debit our expense and credit our asset, the prepaid or the supplies. Bless you. Does that make sense, guys? Or with depreciation, we need to show we've used up a portion of this asset. We debit the expense, depreciation expense, and we credit what we call the contra account, accumulated depreciation on the equipment or the building. Does that make sense, guys? So here are all of Net Solutions adjusting entries. Once we have all of these adjusting entries recorded, we can then prepare the final adjusted trial balance. Okay, let's look at this one, guys. The adjusting entry for accrued wages was omitted at July 31st, the end of the current year. Indicate which items will be in error because of the omission. So like, guys, let's just think of this. If we omitted accrued wages, what would that look like? Accrued wages is a debit to wages expense and a credit to wages payable. Okay? So when we have a wages expense, what does that do to net income? It lowers it, doesn't it? So if we forgot to record this entry, wouldn't it be overstating net income? And wouldn't it be understating expenses? And what about the liability side? Wouldn't it be understating our liabilities? What I want you to think of is when they ask you these questions, prepare the journal entry and see what would go up or what would go down or what would increase or decrease. And there you have your answer. Okay? So wages expense are going to be understated if we don't show that journal entry. Net income gets overstated because we don't have that extra expense. Liabilities are going to be understated. And ultimately, our owner's equity gets overstated because don't our expenses reduce owner's equity? Right? When preparing the financial statements for the year-end period, accrued salaries owed to the employees for December 30 and 31st were overlooked. The accrued salaries were included in the first salary payment on January 6th. Indicate which items will be erroneously stated because of the failure to correct the initial error on the income statement for the for the year December 31st, 2006, and for the balance sheet. Okay, so basically what they're telling me is in 2025, we forgot to show that journal entry. Okay, we forgot to show it in 25, but it did get recorded in 26. So doesn't it make sense? In 26, we overstated our expenses. And as a result, we understated our net income. So salaries expense will be overstated, net income will be understated. The balance sheet will stay the same. What about this one? At the end of October, the first month of the business year, the usual adjusting entry transferring rent earned to a revenue account from the unearned rent account was omitted. So basically, we must have received rent, cash up front for a year's worth of rent. But we forgot to get it out of the liability and put it into rent revenue. What happens, guys, if we forgot to do that? Doesn't our income get understated? Doesn't our net income get understated? Doesn't our liability get overstated? So what I like to do is put out that journal entry and see what should have happened. And since it didn't, you know it was either over or understated. Okay. AZ Construction was organized on May 1st of the current year. On May 2nd, AZ Construction prepaid $18,480 to the city for taxes for the next 12 months and debited the prepaid tax account. AZ Construction is also required to pay in January an annual tax for the previous calendar year. The estimated amount on the property tax for the current year is $45,000. Journalize the two adjusting entries required to bring the accounts affected by the two taxes up to date as of December 31st at the end of the current year. So do you see the first one? Construction, we had prepaid $18,480 to the city. This is May 1st for the next 12 months and debited the prepaid tax account. So $18,480 for 12 months is how much a month? Someone, 18,480 divided by 12 is how much a month? And multiply that times 8 months. Because remember, we have 8 months since we did that May 1st. So 8 months. Perfect. So 12,320 is what we need to now show is tax expense. Think about it. We paid it May 1st for 12 months. As of December 31st, we've used up 8 months. Does that make sense? That's why we're debiting taxes expense of 12,320 and crediting our prepaid taxes. Then that other tax was all for this year. So in that case, we debit our tax expense and credit our payable. Okay, let's look at this one. For a recent year, the balance sheet for Costco recorded accrued salaries and benefits of $4,090,000. For the same year, Costco reported operating income of $6,708 million. Assume that the adjusting entry for $4,090 million of accrued expenses was not recorded at the end of the current period. What would we have shown as operating income? If that expense, $4,090 million, wasn't there, wouldn't that have increased our revenues by $4,090 million? Get it? It's a lot of money. Make sense? For a recent year, Kroger reported accrued salaries and wages of $1,413 million as a current liability on its balance sheet. On its income statement for the same year, Kroger reported operating income of $2,780 million. Assume the adjusting entry of $1,413 million of accrued salaries and wages was not recorded at the end of the year. How much would the operating income have been misstated? Wouldn't it have been $1,413 million? What is the percentage of the misstatement in A to the reported operating income? So you could just take the 1,413, divide that by the 2,780 million. That would have been an error of 50.8%. That's pretty big, isn't it? Is this making sense, guys? So, the accountant for Healthy Life Consulting, a medical services consulting firm, mistakenly omitted adjusting entries for unearned revenue earned during the year of $34,900 and accrued wages of $12,770. Indicate the effect of each error considered individually on the income statement for the current year ending July 31st. Also indicate the effect of each error on the July 31st balance sheet. Set up a table and record the answers. So if mistakenly omitted the journal entry that 34,900 of unearned revenues were in fact earned, what does that do for our revenues if we omit it? Doesn't it understate it by 34,900? Right? And then this one said accrued wages of $12,770 was omitted. What does that do for expenses? Wouldn't that have understated our expenses? Okay. What about net income for the year? If we forgot to include the 34.9, that understates our net income by 34.9 minus our salaries, right? The 12,700. So that would understate our income, and it also 12,770. I'm a little confused what I'm doing. Net income for the year would be understated by 34.7, and I'm trying to think what the error B is. Let me look back here. Sorry, guys. I'm trying to figure out what I did wrong. Oh, let me look. The income statement and then the balance sheet. Okay, so they're trying to show on each one how it's works. But basically in this scenario, you can see how the effect plays out on all the financial statements, which is why you want to get those right. Once we have completed all of these adjusting journal entries, we then can prepare an adjusted trial balance. This adjusted trial balance is real important because this is where we are going to take the numbers for our financial statements. As you see, we will take all of these figures down below from fees earned and rent revenue and all the expenses to come up with our income statement. And then we can utilize the Chris Clark capital drawing and our income statement to come up with our statement of owner's equity. Once we have that, then we can create our balance sheet with our statement of owner's equity and all of our assets and liabilities. So know that next week, we're going to prepare financial statements. These first 3 chapters have been challenging because you're learning all kinds of stuff, but we are almost through to the place of where we're getting ready to do financial statements. Vertical analysis. You're going to learn a lot about this in chapter 15 at the end of the class. But this is a healthy way or a helpful way of being able to analyze information within the financial statements and among companies. In vertical analysis of a balance sheet, each asset is stated in terms of the total assets. So if we look at cash and we look at cash as a percentage to total assets, each liability and owner's equity item is stated as a percentage of total liabilities and stockholders' equity. In vertical analysis and income statement, each item is listed as a percentage of revenues. So here you see one company. We show in 2027 our income statement, our revenues and our expenses. And in 2026, our revenues and our expenses. The fees earned is the denominator. So all of these expenses will be divided by fees earned to come up with these percentages. Do you see if revenues are 100%? We see here that our net income is 50.7% of net income of revenues. Okay. And then you get a good feel of where the expenses are coming through. In 2026, they're pretty consistent. The net income is 52.8% of revenues. And as you see here, I guess the wages were just 30% of revenues versus 32%. This vertical analysis allows you to get a really good overall picture of where the costs are going. Okay? The unadjusted and adjusted trial balance for American Leaf Company is shown here. Journalize the 5 entries that adjusted the accounts as of October 31st. So guys, here we know cash isn't going to be affected, but we know accounts receivable is usually affected. So do you see the unadjusted accounts receivable is 38 and the adjusted shows 44? So that went up 6,000. Let's go look at fees earned. Do you see how fees were at 74 and now they're at 80? Can't we surmise from this that we have an adjusting entry of a debit to accounts receivable for 6 and a credit to fees earned for 6? So we recorded fees earned but not yet billed. Okay, let's look at another one, guys. Prepaid insurance. It was at 20, now it's at 8. That's $12. If we go to insurance expense, it was at 0, now it's $12. Wouldn't that say we prepared an adjusting entry? Insurance expense 12, we credited prepaid insurance for 12. And why would we do that? We adjusted the prepaid insurance for insurance that had expired, used up during the period. Yes? Next, wages payable. It was at 0, now it's at 2. And we can see wages expense. It was at 24 and it went to 26. Didn't we accrue wages payable for the end of the year? Depreciation expense. Do you see it was at 0 and now it's at 4? And do you see our accumulated depreciation went from 8 to 12? Wouldn't that be an adjusting entry of depreciation expense of 4, accumulated depreciation of 4? Do you see how you can look at that and see what changed? Yes? Okay. So no, you can look at an unadjusted to an adjusting journal entry and see what has been changed. Here, they're just showing you, here they prepared unadjusted and adjusted trial balances. What did the accountant do wrong? As you can see here, you can kind of look at the different items and see where they screwed up. So, guys, any questions on this before you head out? Are you guys doing okay? How's everyone doing? So I will make sure I post some problems